So let's jump in here. Let me get myself together. So I am so excited because I have Card Neidermire here, and she's the home loan coach. And she is just going to give us so much good information for first-time buyers and just generally just anybody out there, looking for a loan. Just if you don't know, I'm Michele K, local real estate agent. And if you're watching this, if you would comment so I know that we're going through to everybody, that would be a great thumbs up. I'm supposed to be able to see the things over here. And so, yeah, so Katie, tell us just a little bit about yourself, and then let's get into our question and answer. Put you on the pedestal.
So I'm Card Neidermire. I am a mom of 2 young children. I am a volunteer water polo coach for the women's team at Cal State Long Beach. And I am a self-proclaimed home loan coach. I'm a loan officer, but I really focus on coaching first-time buyers through the process. I have a long history of coaching in my background, and so I love helping people set those goals and helping hit those marks in order to get into a home. I just love educating and explaining. So I partner with my mother, Karen. Together, we make up the Card team, and our company is American Pacific Mortgage, a large mortgage bank. So that's me.
Okay. Great. Okay. I was telling Katie that we got a new, I'm going to just put this out here. We have it's the RPA, Residential Purchase Agreement. And I want to just thank the attorneys of CAR, that's California Association of Realtors, because they have just made that offer so easy. It's a grid where it's like, okay, we're just going to plug these things in. But one thing they did was, we used to say, okay, the loan application is attached, right? Because you're making an offer. Here's my proof of funds. Here's my loan application. But what's interesting is now we have to mark, is it a pre-qualification, which I have going across the bottom, a pre-approval, or a full loan approval? So Katie, can you just explain the difference, which one you supply, all that good stuff, so we know what to do when we get to writing that offer?
Yes, absolutely. So we actually do all 3, but a pre-qual I think of as kind of a verbal qualification, right? Someone shares their income. There's no application, there's no pulled credit, but they're just sharing their information. And maybe, in other days that was okay for, submitting an offer, but those days are kind of long gone. It's not that we don't do them. Typically, if someone's like a year out of planning, then maybe we'll do that because we want to give them a baseline. A pre-approval is going to be an application. We're going to pull credit. We're going to run automated underwriting. That's our technology-driven underwriting process that gives us an approval right away. But it doesn't have the ability to read docs, or because it's really just reading the application. So it's kind of it's a big step forward. It's a great step, but it's not the best.
It's like what you put in is what you're going to get out, but maybe
Yes.
You're not putting in everything. Okay. So
Exactly. So the full underwritten approval, the full loan approval, is what we at the Card team call our ACE approval. You might hear it as like a TBD approval. Basically, it's a fully underwritten approval. From the pre-approval, you still have the loan app. You still have the credit pulled, right? We still collect documents. However, the next step is either the human underwriter or the AI system, right? Our technology is growing, right? So artificial intelligence can also read documentation. They can see maybe where there was something missed. And that's, we like to say it's like cash. Nothing's exactly like cash, but it is. I mean, it's a fully underwritten approval. And especially in this environment that's very competitive, we encourage all of our buyers to do that. And I think you probably know from the listing side, from both sides, it's the most competitive.
Yeah. Okay. Well, I again, congratulations to the CAR attorneys, because I think that has it's a benefit. It's a benefit to our buyers and sellers. So thank you for explaining the difference there.
Yeah.
And then also, again, back to the offers that I write, there's a line in there where it says that this offer is made, right? And says a fixed rate of not to exceed. And I think that a lot of us in the past have been sort of remiss in not putting in a percentage there. So I think, in this current market, right, that, the rates, okay, we're going to talk about that. But, I think that this sort of brought up to me, the subject of especially when you're a first time buyer, locking the rate. I just think those three those three words have a lot to say. And I just want you to sort of expand on that if you could.
Yeah, absolutely. So I know in terms of in writing the offer, right, it's really best in those specific instances to talk with the lender about the specific buyer, right? Because, I know if you have to put an interest rate on there, it's important that you put something that makes sense for your borrower. Some people, if the rate goes up, they'll still qualify. But if the debt to income ratio is close, then they might not. In terms of locking the rate, this is it's something that a lot of people don't understand, right? We have the ability to lock an interest rate in advance for a cost. However, in this environment, again, I don't really suggest it because it's very hard to get an offer accepted, right? Even if you're very, very competitive, if you're going up against 10 or 20 offers on a property, then it's hard, it's just, right, math. It's a low, the odds are lower. So typically, I would say 90%, 95% of the time we are locking an interest rate when there's an accepted contract. So a typical escrow period might be 30 days, maybe shorter in this environment.
True.
So we're locking in that period. It's really important for buyers to understand where rates are going. So to know that if they start now looking in January and rates are changing, which we're going to talk about, and they don't get an accepted offer until March, what's happened with the rates, right? Because we're not locking now, we're typically locking then. Right. So, we lock usually in the first 2 weeks, but we're talking with our borrowers every day once we have that accepted contract about what's happening with rates and advising them.
Right. And I just want to throw it out there for Katie and for all the lenders. I think that they do so much work on the back end that we don't see, researching the market and watching all those very complicated things to figure out what, to give good advice. So, good lender can save you lots of money. So, all right.
Well, thank you.
You're welcome. All right. And so, the other really sort of, it's let me get rid of that locking the rate here. Is if you can explain the conforming loan limits and jumbo loans and all, that's a pretty complicated subject too, but if you could run with that, that'd be great.
Yeah, and it literally can be a 30 to 60 minute conversation about all the ins and outs. But I think the most basic things to understand for us is this: there is a conforming loan limit that is set in the entire United States. Right now it's 647. Okay. And if you live in a high cost area, then that conforming loan limit is higher. In LA, in Orange County, it's 970 now.
Wow. That's such a big difference.
Yeah. And last year it was 822. So even from last year to this year, it has jumped by a lot. So why is that important? Because all the loans, if you're going in a conventional loan, all those loans have the same rules, the same guidelines, and there's not extra like overlays or extra guidelines as when it comes to jumbo. Okay. And jumbo is over that 970 in our counties. And when you get to a loan over that amount, there are extra rules essentially. The biggest ones that we run into are a lot of programs require 20% down, no longer 5% or 6%, whatever. You have to have the 20%, and then you have to have extra money in the bank after you close. That's the one.
This is on the jumbo, right? This is
on the jumbo.
Right. Okay.
That's why most people tend to not qualify for that, for those different jumbo investors. And so they are in that conforming, they have to stay in that conforming loan limit. So how does it really impact people? If someone was told before by a lender that they only qualified for 822, then likely they might have been able to qualify for more if that loan limit jumped up. Gotcha. So if they were in that limit before, if they had that limit, then maybe they'll qualify for more and they should reach out.
Okay. And when did that differentiation come in from the rest of the United States and California? Have we always, like the past couple of years, always had a higher limit?
I think it's been for a long time. I am, 5 years into this profession. So that's actually something that I don't know how long it's been going on, but I would assume for a long time because, our properties have always been valued higher.
Yeah.
So
Yeah.
it's what helps people to buy.
Yeah. Wow. I mean, it's just really telling. Like, that's a huge difference, right? 300,000.
Yes.
Yeah. Okay. So, all right. So here we are, right? It's the hot topic. Wow. Yesterday, the news just imploded with everything. So let's talk about the rates. Where do you think they're going? How it's going to affect your applications and payments and all that good stuff?
Yeah. So, I think the biggest thing to understand is, since the pandemic, really since the beginning of 2020, in order to help stimulate the economy, the Fed rate has been close to zero. Okay. Now, the Fed rate impacts many, many things, but it does have an impact on our mortgage interest rates. So, really, the other thing that they were doing is they were buying higher than normal amounts of mortgage-backed securities to keep interest rates low. So basically, we've been doing all these things. Our government has been doing all these things in order to help keep our interest rates low because of where our economy was and what was going on. And now they're starting to change. Okay. So the Fed is selling off bonds, which increases interest rates. That's a lot of the stuff happening in the market. There's other factors like inflation. And now the Fed rate, because it's been so close to zero, they have to help cool inflation. So they announced that they're gonna increase the Fed rate. Again, not an exact impact on interest rates, but it's one of the factors. It's one of the things that it impacts borrowing, it impacts lending, it impacts economic growth. So what does this mean? It means that we are going to see interest rates rise. How fast? We don't know. But the biggest thing and how it impacts, someone who wants to buy, is this. If your interest rate goes from 3 to 3.5% in a loan amount of about 750, okay, which is, I would say, pretty, normal in our area, maybe a little higher, but the difference is like $200 a month. And so all of a sudden, maybe that becomes a borrower that can't qualify for that much of a loan, or it becomes an issue where, they were already at their max and they don't want to go that high in their monthly payment. So yes, it's going to impact if borrowers move forward and how many buyers are going to be out there looking.
Right. I just think the interest rates have been really low. I mean, this is right. It's still low. Even, okay, say it's 3.5 today. I don't really even know. But I think what I've seen with my buyers is when they sit down and the lending, it's like, oh, well, you can afford this much of a house, but everybody stays under that amount. So, I'm hoping, I'm sorry that everybody's, payment's going to go up a little bit, but I think that there's still some wiggle room there. I mean, do you sense that? I mean, I don't know. What do you think?
Well, I mean, I think that every situation is different. And I think that, look, there's times when there's only one borrower, but maybe there's two earners and we're not using the income of someone else. So maybe they can go higher and they feel comfortable in terms of, being at your max loan amount. Obviously, there's so much qualifying income that we can, approve somebody for, right? And if they're at their max, that is a comfort thing of if they feel comfortable moving forward. As interest rates go up, their max is going to go down a little bit, right? Now, they can control that in some ways if they have debts that they can pay off, right? Or they can save more money. There's different strategies. That's one of the reasons that I love working with people to strategize what can we do, right? What payments can we lower? So
right. And our next topic, and Katie brought this up, tax returns are coming, right? We're putting them in. And she said, especially, it's true for everybody, but especially people who are self-employed and you're thinking about buying next year or 2 years, you need to talk to Katie sooner rather than later, correct?
Yeah. So it's really this idea of, self-employed people have the ability to write a lot of things off. And that's very normal. Why? Because we want to pay less taxes. So we want to show less income. Right. However, if you are in a position where you want to refinance or buy, right, in the next few years and you're self-employed, then it's going to impact what you can qualify for. We take 1 to 2 years depending on the program. So sometimes we average 2 years tax returns. So if your last year was really low, then you really need to make sure this year you show more income. So it's really about helping us to whoever your trusted lender is. Of course, I will do it, but having them review your draft returns before you hit submit. I mean, that's really what it comes down to, is just looking at it and saying, look, this is what you qualify for. Not only that, not only self-employeds, but also like someone who maybe owns, this isn't first time buyers, but maybe someone who owns rental properties, right? Or investment properties. If they're showing big losses, that can also impact them. So, again, bottom line is review the taxes before, unless you are a W-2, very basic, employee. So.
And, and even for people who are just W-2, I had a young girl come to me and she's smart, she knew she's a couple years out, but I was like, talk to the lender now.
Yes.
What can it hurt? They can advise you. Wait, it's not really. I can advise you to go to them and talk to them. So I always urge that.
Sooner is better. Sooner is better because you can plan, right?
Yeah,
we
right.
can the markers of where we need to be.
Right. Goals, right? I mean, it's right, that whole thing, or we all set the goals. So, all right. I don't know if there's anything else, you want to talk about that, anything else we need to impart here, words of wisdom for the lending right now?
Yeah, no, I think the biggest thing is just being prepared, right? I think the more you are prepared before you really start jumping in and getting serious, the better off you are, so, speaking with you like about the market, right? And what's happening, right? Speaking with the lender about, where rates are, what you qualify for now, how you can maneuver your financial situation in order to put yourself in the best position. Right. Credit. I mean, that's a whole nother thing.
Subject. And, and I think a question, that I just, or want to answer for a lot of people, it's always like, okay, like I have to call a lender. And I think people get like really nervous about it. Just list to them the things you need from them, because it's not that bad, right? So
yeah, no, that's great. And honestly, it's so funny. I feel like I'm not scary at all, but I do understand just the thought of calling somebody or having a Zoom with someone you don't know. In my initial consult, really it's about obviously getting to know them and their situation and their full story, right? What's your goal? Where are you going? And a timeline. And then in terms of the financial information, which I say, are you okay with me taking this? Are you okay with sharing this with me? It's really right income. If they're self-employed, then I typically want to see their tax returns, but what's their income look like? We want to see longevity. What do their debts look like? Are they following their FICO score? And then lastly is savings and really concerns, what are the concerns? So it's really not a huge thing. I usually give them in advance. These are the things we'll talk about. And I'm pretty easygoing. So I love hearing about other people and what they want to do and helping them get there.
Yeah, great. Okay. Yeah. Katie, thank you so much. I just, she really is the home loan coach. She just, just explained everything so clearly for me. And if you have any questions and you need her contact information, Michele K. Katie, have a great day, everybody. Thank you so much.
Thanks, everybody. Thanks, Michele.
Bye now.